Hi, everyone. Welcome to another episode of Tax Talk Unfiltered. This is the first episode of season 2, which we're excited about. Hopefully, you enjoyed season 1, and we've got a great topic today to kick off our new season. We want to talk about health insurance. It's the annual enrollment period for a lot of folks right now. Tal is going to touch on that, and so this is really top of mind for people who are both employees, but more specifically, what we want to talk about in today's episode is what happens if you're a business owner and health insurance is on you. You don't have an employer that's going to provide it to you as a benefit, and you need to figure out how you go about that and how it could impact your taxes. So I'm your host, Spencer Carroll, CPA, joined once again by Rachel Richards, CPA, our head of product here at Gelt, and Tal Binder, our CEO here at Gelt. And so we're going to talk about how the deduction...
CPA.
Yep, not a CPA. You know, I like to say honorary CPA, but then Tal always corrects me with that, so I left it out this time to relieve any confusion there. But we're going to talk about health insurance deductions, how they work across different setups, what's permitted, what's not permitted, what you need to watch out for, and how to coordinate payroll, bookkeeping, and of course your tax returns, because that's what we do here at Gelt. So Tal's going to kick us off to kind of set the stage, and then we'll start talking about business ownership and health insurance as a business owner.
Yeah. I think that the reasoning behind this episode is really that it's the time of the year. So many of our clients, but not just them, friends, family, are renewing their health insurance and their health plans, and they're trying to make a decision. And there are some areas that are very tax related because it's, you spend money. Usually when it comes to money, there is a tax aspect, but in some cases, it's not just about taxes. And so we want just to cover a couple of scenarios to talk about what options people are facing and what is available to them, and we'll take it from there.
Great. Okay, so let's say that you, in 2025, you're a new business owner, things are starting to take off, and now you need to worry about health insurance. You're no longer getting it from your employer. Set the stage, what are your initial options as you get into entrepreneurship?
So let's start with what are the scenarios even available. So option number one, you're going to the marketplace, like to the state marketplace or the federal marketplace, wherever it is, and you're picking health insurance on the state marketplace, let's say. Option number two, you're going to Gusto or whoever is processing your payroll, and they will offer you their own health insurance, probably. And option number three, you are insured by your spouse, and the company of the spouse is fully covering your health insurance. That's option number one. And option number two, if insured by the spouse, they are covering some of your health insurance, which is very, very common, and you need to pay for the other portion, like for them. Those are kind of like I would say the 4 different scenarios as a business owner.
Or you could have a group plan for your business. Like the first 2 were your individual plans, so you can pay for your individual plan personally, or you could have a group plan that your business pays for and you're covered under there, right?
Right, and even if the business is paying for your group plan, sometimes it will pay for some of the group plan, sometimes it will pay for everything. It really depends what you are giving to other employees in your company.
But even if the business is paying for the group plan, 100% of what they're paying for is relevant for you.
Yep, it's still relevant. But those are kind of like the scenarios. Let's start with scenario number one, that they are just going and getting an insurance from the marketplace. Rachel, do you want to cover that?
Yeah. So if you're a business owner and you're getting insurance either from the marketplace or just any individual plan, if it's through the marketplace, based on your income, you may or may not have a subsidy. If you do have a subsidy, then when you file your tax return, based on the income that you actually have when you file, you might get an additional subsidy or have to pay some of that subsidized insurance back with your tax return. Assuming that you either didn't get any subsidy or you just have some kind of individual plan that you're paying for, you as a business owner would have 2 options. Either you pay for that individual plan or your business might reimburse you for that individual plan. In both cases, you're able to get a deduction for those health insurance premiums. But what type of business you have is really important for how you actually go about getting that deduction. And I can pause there to see if we want to dig in
Yeah,
further.
I have a couple of things to add to that. Like health insurance premiums is what you're paying in order to be insured. It's not your deductibles. It's not your out-of-pocket maximum. It's not like the co-insurance. Like if you need to pay $10 for whatever drug you need from CVS, that's not going towards the health insurance premiums. Insurance premiums is the amount of money that you're paying in order just to be insured. And that part is what's relevant for that deduction that we're talking about.
And question for you, Rachel, that I thought of as you were explaining that. Are there scenarios where you have to pay for your insurance personally and then be reimbursed by the business? And are there ever scenarios where the business itself can just pay for the premium straight out of the business bank account and you do not have to pay it personally and then get reimbursed?
Yeah. So again, depending on what kind of business you have, if the plan is in the business's name, then the general expectation would be that the business is going to pay for that plan out of the business account. If the plan is in your personal name, then either you would pay the premiums personally or the business should reimburse you for those premiums. What you want to avoid is if you pay the premiums personally and your business is not reimbursing you for those premiums, if you're taxed as, say, an S corporation, if that happened, that would mean that you can't get a deduction. So how the premiums are paid or reimbursed and how they're reported, especially for S corps, is really important to actually being able to get the tax benefit from making those payments.
Got it. So you're saying that it kind of depends on the entity type that your business is, whether you have to pay it personally or the business can pay it on your behalf. But you're warning people that if you are the entity type where you have to be reimbursed, meaning you have to pay it personally first, and you don't actually make those reimbursements before the end of the year, then you miss out on the deduction. You can't go back in time and count the
You either have to make the reimbursements or at least record the payable in your accounting. So if the cash hasn't switched hands, that's okay, but you do need to record that as a payment that's reimbursable to you from the business in order for the business to get the deduction. And for S corps in particular, the business also needs to report those premiums that they paid on your behalf, really specifically on your W-2, in order to be eligible for that deduction. And the reason that's coming in place is because you would be an over 2% shareholder of that business.
And I think that a lot of people are getting really confused by who is responsible for that, who is doing that, and that exact adjustment. So we want to be very clear. Like when you're thinking about your team, you have like a couple of functions in a team. You have like tax professionals, for example. They really understand in taxes, so we can tell you this is what needs to happen in order to claim the credits. But then you have also the bookkeeping. The bookkeeping function is whoever is managing your books. Basically record each financial transaction in your business in a US GAAP way and make sure that you can produce financial statements for your tax team. So we are the consumers, we as Geld, consumers of your bookkeeping. And when we get basically the financial statements, we assume that you already did that, for example. And another thing, payroll. So sometimes your bookkeeper will not do the payroll administration for you because payroll administration is different than bookkeeping. Sometimes it's attached to each other, and you like a platform like I think ADP or Gusto, making it very easy and simple. But somebody still needs to manage those kind of like softwares for you. It's either it's you by yourself, it's your bookkeeper, it's somebody. Sometimes bookkeepers do that, sometimes they don't do it because payroll by itself, it's kind of like a lot of headache and there are a lot of specific and special rules depending on the state. But somebody needs to do that. So when it comes to health insurance, choosing health insurance is usually up to the business owner, especially if it's small business. Then recording properly the health insurance, usually it's something that you need to start configuring through the payroll software, and then the bookkeeper needs to record the payroll entries correctly in your books. When I say record them correctly in your books, it means like taking the data that from the payroll and just record it as defined by the US authorities and specifically the IRS, how it needs to be split in your P&L and balance sheet, depending what it is. That's what it means. And so usually there is a lot of like a hot potato kind of situation. Who is responsible for doing the recording? If it's the payroll option needs to be done by the payroll administrator. The bookkeeping option needs to be done by the bookkeeper. Claiming that as credits and taking it against your taxes, that's being done by the tax professionals and the tax team. So I think that's another thing that a lot of people are kind of confused by. And I'll be honest, I'm confused by it a lot of the time. And if I had to do it for myself, I would be confused. And I know quite a lot about taxes. And it's still something that I think people are not sure what needs to happen. But yeah, usually it's you as a business owner need to work with your payroll provider in order to record it properly. The bookkeeper will adjust it accordingly in the books, and the tax professional is taking it all and make sure that you're taking the right deductions. I think that's kind of like the proper flow of information that needs to happen.
Now, from a tax perspective for our clients who are business owners, is there one or the other that is considered more tax efficient, either getting reimbursed from your business for paying your health insurance personally or having the business pay for the health insurance directly?
Rachel's dogs are allergic to health insurance. They're consuming so much. They're just like running away from the room. Going away. I think, and Rachel, correct me if I'm wrong, because you know more about that than me. I think that there is something about FICA, like depending who is paying what. No?
So it's exactly the same if you pay it and get reimbursed, or your business pays it and reimburses you. From a tax perspective, you're getting the same exact outcome. Okay. So it all really comes down to that W-2 reporting for S corps. If you're a single member LLC that's disregarded, regardless, everything's getting reported on your personal tax return. There is no payroll. So the reimbursement part isn't as essential. You'll get the deduction no matter what. But for S corps, they have a specific requirement where in order to be deducted by the business, if you're over 2% shareholder, then the health insurance premiums need to be reported in a specific way on your W-2. And one thing to mention, because I keep saying your W-2, your W-2, your W-2, just because they're reported on your W-2 does not mean that they're considered income. So to get into the details a little bit, what will happen is your business will have a deduction. So that makes your business income go down. And then on your W-2, you have 3 different types of wages. So box 1 is your wages that are taxable for income tax purposes. You have box 3, which has wages that are taxable for Social Security, and box 5 that are wages that are taxable for Medicare. So when you're reporting your health insurance premiums, they're only going to go in that box 1. So that's wages taxable for income tax. And then they're also going to go at the bottom of your W-2 in box 14, which is other adjustments. So what happens on your tax return is at the very top, your income is going to go up by the amount of health insurance you had. And then on the same form, your income a little bit lower down, your income is going to be adjusted down by the same exact amount. So the net effect on your tax return is your gross wages are going to look a little bit higher, but your adjusted gross income, what you're actually going to be taxed on, is exactly the same. You're just getting that deduction from the lower business income. So even though it might feel like, oh, I have to put it on my W-2, am I going to be taxed on this? Even though it's technically in that taxable income box, if your tax return is prepared correctly, it will not increase your taxable income. And that's why it's really important, especially with these little technicalities, that you make sure that your tax return is being prepared professionally and get those deductions taken in the right places.
So I have heard, I don't know enough about it to feel confident talking about it. And so I'm hoping you do, Tal, that if your healthcare costs are high for whatever reason, you or in your family, that it might actually be beneficial from a tax perspective to be treated as a C corporation instead of a disregarded entity or S corp partnership. Is
Yeah.
that correct, and why?
So as everything in taxes, it really depends on the circumstances. But let's again break down. You have the health insurance premiums, you have the deductible, and you have like your out of pocket maximum. What it basically what we are saying when we are talking about that is that sometimes you would go and get treatment for something that is might not be covered by insurance. It might mean that you have a provider, healthcare provider that you want to go with, but the insurance does not support that, but you really, really need to go with them for whatever reason. And health is something that you don't screw around with. So you say, okay, whatever money it costs, I'm going to pay it out of pocket. And you end up paying $50,000 out of pocket because, as you should, you prioritize your health over like a couple of dollars here and there. Of course, it's a very privileged situation if you can just spend like the $50,000, but we're talking about that situation, like that it's a very large amount of money that you need to spend out of pocket, unrelated to insurance, not covered or reimbursed by insurance. In those situations, there is the question of like what happens to those $50,000, and you have basically a couple of options to go with. Option number one, you can, if it's large enough amount, it can go under your itemized deduction on Schedule A on the personal return. However, it comes with a lot of caveats and limitations. In order to deduct those costs under your Schedule A, you can deduct only the amount that is greater than 7.5% of your AGI. So, like, let's say that your AGI, the adjusted gross income, is $400,000. 7.5% of that, it gets to around $30,000. And sorry if my math is incorrect. But about $30,000, and let's say that your total expenses were $40,000 out. That's something that like the insurance didn't cover at all. What happened? Like you will be able to deduct only $10,000 of those $40,000. Anything that is beyond that kind of limitation, it can suck. And if your income is $500,000, suddenly you'll be able to deduct only $2,500. And if your income is greater than that, you might not be able to deduct anything at all. So it really depends on your personal situation and income, whether you should go for that direction or not. But if it's a really significant amount, you have another options, which is through corporations, C corporations specifically. And under C corporation, you will be able to create a health reimbursement plan, health reimbursement arrangement. I think that's the HRA. And under that, you can have a policy that the company is being responsible to cover the employees' health expenses. Up to a certain amount, there is a policy. It is really important, and we are not specialists on HRAs, by the way, but it is really important to mention that there is a really good chance that all of the employees in the company would need to be covered by that. So it's really great if the only employees are you or your family, or it's kind of like something that is very kind of like constrained. Let's put it that way.
Yeah, I can jump in there and just say that like if your business sets up a health reimbursement arrangement plan, so an HRA, your business is committing to fund a special account with a certain amount each year. And then the employees of that business, if they have medical expenses, can be reimbursed from that account. So you need to commit to funding a specific amount every year. The amount any unused amounts can roll over. And if an employee leaves the company, they don't get to take any of those funds with them. But it is something that if you have other employees, it's not something that you can do just for yourself. And now you can continue, Tal.
Well, and before you continue, Tal, HRAs, are they only C Corp eligible, or can you have an S Corp and also create an HRA if you want to?
You can create an HRA with any type of business, but if you had an HRA with an S Corp, the benefit of the HRA is that those medical expenses, which would usually be, limited to your itemized deductions, can be reimbursed tax-free. But if you're a 2% owner of the S Corp and you have that HRA, then because you're the 2% owner, you're considered self-employed. And so those reimbursements to you will be taxable. So if you're an S corp, you're not getting the same tax-free benefits that you would if you were employed as a C corp employee.
Got it. And it would be the same if you had a Schedule C business or a partnership. It would still be
Yeah.
considered
So
taxable.
if you have other
Yeah.
employees, they would get the benefit, but you would not. But if you do have other employees, then the decision to do this in the first place might become more complex anyway.
So that's the key, is that's why you need to be a C corp, because the HRA is only tax-free to you if you're employed through your own C corporation. And
And
so
it's
I
about
would,
all employees. It's about all the employees of that C corp, which is important to mention. That's why it's so like there are cases and there are
It's like a
certain.
really special person who this is right for.
But we have many clients. We have, I think, at least, I think it's double-digit clients that deploy that strategy, and it works great for them. And it saves them a lot of money because they have this kind of need. But it's something that it's really important that to be planned because there are also a lot of downsides to have a C corp. So like there are a lot of considerations around that, and it really depends how much money you're going to pay, and it's something that is complicated and more advanced. But there are solutions for business owners who are high income, let's say making over $500,000 a year, like, and they have a lot of like medical expenses for whatever reason, whether it's temporarily or like constant. Like they have some types of solutions. It just needs to be very carefully planned to make sure that everything is like kosher, and they don't lose too much in other places. So that's I think the important part of that. Yeah.
so the HRA through the C corp is right for a very specific type of client who consistently, year over year, has high healthcare costs. You wouldn't want to do this if just 1 year you had a high healthcare expense year, but you expect it to drop back down.
And even if you have high health insurance costs, you still might not want to do this if you're living off your business and all of the profits are going to be taken out, because with the C corp you would be paying, double taxation. So it's definitely something to consider.
I have one more thing to add to that, and that's a situation when you can deduct it. There are situations that you just cannot deduct it. Like if you have an S corp and it's just like not like it's not, and you have high income S corp, you might be in a place that you just cannot deduct those expenses. If your income is too high and it doesn't cross the 7.5, yeah, you're kind of like screwed, and you need to bear those expenses yourself. So there are situations where you can deduct health insurance expenses, that not the premiums, again, the deductibles, the out-of-pocket maximum, and anything that is not covered by your insurance. There are situations that it can be mitigated, but those are very specific situations. And in other cases, there is nothing to do, and you need to just like take it against your from after tax money, which sucks. It really sucks, but that's the situation.
Yep. So taking a step back, that was a good segue, Tal, away from the HRA C Corp strategy, going back to, the majority of our clients, which are pass-through business owners. What, just generally, what is deductible before considering the itemized deduction? Is it just the healthcare premiums? Is there some of the meeting your deductible out of pocket? Like what can people normally in the ordinary course of business in a year deduct healthcare wise?
So your health insurance premiums are generally deductible. Any out-of-pocket expenses, so co-pays, doctors, dentists, contacts, eyeglasses, prescriptions. If you're going to a lot of doctor's appointments, the mileage that you're going back and forth to different appointments, a portion of that. If you need to, I believe if you need to travel,
we have clients that they needed to fly actually to another location to get a specialized treatment. The travel costs as well, those are considered.
So the premium, because I'm trying to think about it comparing being self-employed to being a W-2 employee. And in general, as a W-2 employee, your premiums will probably be significantly less because your employer is sponsoring the plan and paying for some of that premium,
Well, your
depending.
premium's the same, but someone else might be paying for part or all of it.
Yeah.
Yeah.
So your month to month cost being a business owner versus a W 2 employee would probably be higher because the premium, you're paying for all of the premium. But there are added benefits to having healthcare through your own business compared to being a W 2 employee because W 2 employees cannot write off out of pocket copays, deductibles, travel, stuff like that, unless they can itemize above the 7.5%. Am I understanding that?
Oh, well, maybe I misunderstood your question then, because all of those expenses I listed are deductible as medical expenses on your individual tax return
Got it.
limited to AGI.
Okay.
So only the health insurance premiums would be deductible by the business unless you have a health reimbursement arrangement.
Okay. Okay. Got it. Yeah, that was what I was asking. So good.
Okay, so I gave you a completely different answer to that question.
No, that's good because I was thinking in my head, I was like, wow, yeah, the premiums will be more, but there's so much more beyond the premiums that you're getting the benefit out of that you're not getting as a W-2. But okay,
No, no, good clarification then.
yeah. And then what if, whether you're a W-2 employee or whether you're self-employed, if you go with a high deductible health plan, benefit, if you see it this way, is you can contribute pre-tax to an HSA. It grows tax-free and you can pull the money out tax-free as long as it's for a qualified health event or cost.
Mm-hmm.
You can still do all those same things as a business owner through your business.
Yeah. So you can still have a high deductible health plan, can still contribute to an HSA as an employee. If your employer contributes to the HSA as the business owner, you're both sides. So it's really the same thing if you're contributing as an employer or the employee. But if the employer contributes, they're getting the benefit, they're getting the deduction. And then if you as the employee are contributing to the HSA, then you're going to get the benefit on your personal tax return. And then you can use the money that's in that HSA. Like you said, it grows tax free.
Really
And then if
allergic to
you
that
do have,
subject.
and then if you do have medical expenses like, doctors, dentists, all of those types of expenses that usually would be limited to based on your income, having that HSA can give you a little flexibility to deduct those tax free. Or to, basically get a deduction for.
I do want to mention that if the employer, if you're a very closely held S corp, and it's better to take the HSA through the payroll through the employer rather than pay it personally, because I think that's where it impacts the FICA, like the Social Security and Medicare differently. By the way, we can verify that.
Yeah.
We can verify that, but I think that if I remember correctly, there is something there. And I know that we don't have a lot of time, but I think that there is another topic that is not tax related actually to bring up. People are asking us which plan is better for them because some plans are HSA eligible, some plans are not HSA eligible. Did we talk, by the way, about the HSA and the triple tax benefits of the HSA? Did we explain that?
I just mentioned it briefly in explaining my last question to Rachel. If you want to touch on that real quick, and I know one other thing we wanted to touch on was the difference between HSA and FSA. So if you
Let's combine it because it's kind of like combined. So HSA versus FSA. So HSA is basically a saving account that is available, health saving accounts, that's the HSA, that is available basically only to high deductible plans. So you can take it usually when the deductible, like only eligible plans allow you to contribute to the HSA. The number and how much you can contribute to the HSA changes every year. By the way, they publish every year different numbers. It's around if for individual this year it's about $4,000 or $5,000. For a family, it's double that, so it's about 80. I think it's between $85,000 to $10,000. If you are over the age of 55, you have an additional contribution that you can make, and the contribution that you're making toward that is fully deductible. So whatever you contribute into that, it's going to be deducted from your taxes, which is really fun. You can use those funds to cover some of your out-of-pocket expenses that you have later on. The triple tax benefits of HSAs that you can contribute the money towards the account every year. The money in that account, you can invest it, and it can grow completely tax-free over time, which is cool. It will go with you year after year, and you can just keep accumulating that. I think we have a client, by the way, with about $400,000 in their HSA account. So no names, of course, but good job, client. And basically, the money that is being invested in that account is being like, you can either use it for health purposes, or you can just like keep it invested. And when you cross a certain age, and I think that the certain age is 60 something, you can pull the money out of that account after you accumulated all the profits without any taxes. But you know what? I think we don't have enough time to fully explain that. So I want to stop here. We might need to have another recording because I have to go. I'm late for 5 minutes for another one.
No problem. Rachel and I can wrap up if you've got to run.
Okay, bye.
But
bye, guys. Thanks.
Yeah, thanks.
Bye.
And so to carry on with what Tal was saying, and Rachel chime in too if you've got more to add. Once you hit a certain age, you have to start pulling it out, or you can. Maybe you have to, or you can.
It almost acts like a Roth at that point.
Yeah.
So you can ultimately take the money out, I believe, for non-medical purposes and still not pay tax on it. But the triple tax benefit is you're getting a benefit when you're putting the money in, the money's growing tax-free, and then when you're taking that money out, which presumably is to reimburse you for qualified medical expenses, you're also not paying any tax.
Yep.
So it's something that if a high deductible plan is attractive to you, maybe you're not expecting to have a huge amount of medical expenses, you'd like to pay less for your premiums, then this can be a really great strategy.
And a cool tax and retirement strategy that I have learned about with an HSA is, like Tal mentioned, you can have the medical expense, but you don't have to use your HSA money to pay for that medical expense if you've got the cash on hand. But if you're good at record keeping, which I am not so great at, and I'm going to have to learn how to as I get into HSA contributions, as long as you've got that receipt, years later, you can still pull the money out tax-free before you hit 65 years old, because it was still for that qualifying health cost that was 5 years later. So if you had a $5,000 health event, yeah.
I just learned that.
Pretty cool. I learned it too recently.
And very cool.
Yeah. So that client of ours that has $400,000 built up in his or her HSA, as long as he's keeping some sort of spreadsheet of receipts for, deductibles, out-of-pocket expenses, whatever, if he's 45 years old and wants to pull money out for a vacation tax-free, he just has to have the receipts to support that amount of money that he wants to withdraw from the HSA, and he still gets the triple tax benefits. So I have heard some people call it the ultimate retirement account for that reason. So be good about keeping your receipts on hand. But anything you want to add, Rachel, before we sign off? We've already lost one member of our podcast.
No, I think we've covered what we could with the time we have.
Yeah. Okay, great. Well, thank you everyone for tuning in and listening to another episode. Send us comments, notes, what you want us to talk about next. We'd be happy to consider it for our next topics. Thank you, and we look forward to the next one.